Indonesia will tighten nickel production to stabilize prices. That single line, buried in a policy update, quietly sent a ripple through global markets this week. Traders reacted. Battery makers paid attention. And somewhere in Manila, policymakers probably paused for a second. Because here's the uncomfortable question no one wants to say out loud. If Indonesia controls the tap, what happens to everyone else trying to build the future? Nickel isn't flashy, it doesn't trend on social media, but it sits inside almost everything powering the modern economy. Stainless steel skyscrapers, lithium-ion batteries, electric vehicles. If oil defined the 20th century, critical minerals define this one. And nickel? It's at the center of it all. Indonesia produces roughly 60% of the world's mined nickel. That's not dominance. That's gravity. When Jakarta adjusts output, whether through quotas, mine approvals, or export controls, global prices move. Investors rethink models. Supply chains twitch. The Philippines is the second largest producer. On paper, that sounds powerful. In reality, it's more complicated. For decades, the Philippines has exported raw ore, ships loaded with laterite nickel sail out of Surigao and Palawan. Value-added processing? Mostly done elsewhere, often in Indonesia itself. That's the uncomfortable irony. Philippine ore, Indonesian smelters, Chinese investment, global batteries. And now Manila wants to change that. There's growing talk of downstream industrialization, building local processing plants, refining facilities, maybe even battery precursor production one day. It's ambitious. It's overdue. It's also expensive and politically sensitive. But here's the catch. Indonesia didn't just become a nickel giant by accident. It banned raw ore exports years ago. It forced processing to happen domestically. It offered policy clarity, sometimes rudely in crane. And yes, it absorbed environmental and political costs to build smelting capacity at scale. Now Jakarta is cutting or tightening output to support prices after a global glut. Too much nickel flooded the market in recent years, pushing prices down sharply. That hurt Indonesian revenues. So they're recalibrating. Smart move. For them. But for the Philippines, lower Indonesian supply could lift global prices. That sounds good for Manila at first glance. Higher prices mean more export revenue, more fiscal breathing room, maybe even more investor interest. But it's not that simple. Higher prices also make downstream investments riskier. Why? Because smelters need stable, predictable feedstock costs. Volatility scares long-term capital. And if Indonesia decides to adjust output again, tighten today, expand tomorrow, the entire regional pricing environment becomes unstable. Investors notice that. And there's another layer people don't always talk about. Indonesia already has a processing ecosystem. The industrial parks. The power supply heavy, yes, but consistent. The Chinese-backed high-pressure acid leach facilities. The integrated supply chains feed directly into EV battery production. The Philippines is starting from scratch in many areas. Power costs are higher, infrastructure gaps exist, environmental politics are sharper. Local opposition can slow projects. Capital costs are steep. So when Indonesia cuts output strategically to protect its domestic industry, it isn't just managing prices, it's reinforcing its leverage. Let's make this real. Imagine you're an international battery manufacturer. You need a secure nickel supply for the next 15-20 years. Do you invest in a new processing chain in the Philippines, where policy signals are still evolving? Or do you double down in Indonesia, where the government has already shown it's willing to reshape markets to defend its nickel strategy? That's not a theoretical dilemma. That's happening right now in boardrooms. The Philippines faces a paradox. It benefits when Indonesia restricts exports because it opens space in global supply. But it also competes with Indonesia's deeply entrenched downstream ecosystem. And Indonesia's ability to control output gives it influence over pricing cycles that Manila cannot match. This is where things get uncomfortable. Can the Philippines industrialize in nickel without first restricting its own raw ore exports? Can it build smelters while still shipping unprocessed ore abroad? Can it attract investors without offering the same kind of hardline policy clarity Jakarta imposed? Or does it need to take a harder path? Nickel isn't just about metal. It's about sovereignty, about who captures value and who stays at the bottom of the supply chain, about whether Southeast Asia becomes a manufacturing hub or just a quarry. Indonesia chose confrontation years ago, against market logic, against some foreign investors, even against short-term revenue losses. Today, it dominates. The Philippines is at a crossroads. Indonesia tightening output is not just a market adjustment. It's a reminder. Control the mineral, control the leverage. And Manila now has to decide, remain the reliable ore supplier or finally become something more. That's the real story behind those quiet policy lines. When Jakarta adjusted its 2026 nickel mining quotas under the RKAB system, it didn't come with fireworks. No dramatic export ban, no fiery speeches, just revised approvals. But in the nickel world, that kind of bureaucratic move can hit harder than a headline. Indonesia is cutting back production, and not marginally. Industry estimates suggest reductions could reach roughly 30 to 34% compared to recent baseline approvals. For a country that supplies around 60% of the world's mined nickel, that's not a small calibration. That's leverage. To understand this, you have to look at what happened over the past few years. Indonesia expanded aggressively. New smelters came online. Industrial parks in places like Morowali and Weda Bay scaled fast. Chinese-backed processing facilities multiplied. The idea was clear: dominate not just mining, but processing and battery inputs. And for a while, it worked almost too well. Global nickel supply surged. Prices, after spiking during the post-pandemic and energy transition hype cycle, began sliding hard. Oversupply became the new problem. That's the backdrop to the 2026 quota tightening. Through the RKAB framework, which essentially determines how much each mining company is allowed to produce, the government is dialing down output approvals. Fewer tons authorized. More scrutiny. Tighter alignment between what is mined and what can actually be processed domestically. Jakarta's reasoning is straightforward, at least on paper. First, stabilize prices. Oversupply has been punishing for producers and has complicated investment planning. Nickel prices have been volatile, and volatility makes industrial policy messy. Indonesia doesn't just want volume, it wants sustainable margins that protect miners, smelters, and state revenue. When you produce more than the market can absorb, everyone feels the squeeze. Second, there's fiscal stability. Commodity-dependent economies know this pain well. Boom years fill the treasury, bust years blow holes in the budget. Indonesia is trying to smooth that cycle. By controlling production more tightly, it can influence supply dynamics and avoid the kind of price collapses that make long-term planning difficult. This is less about quarterly export numbers and more about protecting a multi-decade industrial strategy tied to EV supply chains. Third, officials have framed the cuts as part of improved environmental and governance oversight. Rapid mining expansion brought concerns: illegal operations, deforestation, tailings management, regulatory gaps. By tightening RKAB approvals, the government strengthens its ability to screen projects and ensure compliance. Whether enforcement keeps pace is another debate, but politically, it signals control. Indonesian ministers have also emphasized something more strategic: alignment. Production must match processing capacity. There is little sense in flooding the market with ore if domestic smelters cannot absorb it efficiently or if downstream facilities are not ready. Output, in their view, should move in step with industrial investment. Mine when you can process. Expand when downstream capacity is ready. Slow down when the market is saturated. This reflects a deeper shift. Indonesia is no longer behaving like a typical raw commodity exporter chasing maximum tonnage. It is acting like a state that understands it holds structural power in a critical mineral market. It can adjust supply through regulatory mechanisms instead of blunt export bans. The tool is technical: quota approvals rather than public confrontation, but the effect can be just as significant. If the full 34% reduction materializes in practice, global supply expectations will tighten. Even if actual production ends up slightly above those figures due to revisions or implementation nuances, the signal itself matters. Markets respond to perceived constraints as much as to realized shortages. Traders, battery manufacturers, and investors recalibrate models quickly when the dominant producer changes course. At its core, this is not just about nickel tonnage. It is about market management. Indonesia expanded when it needed to build dominance. Now it is consolidating, stabilizing, and protecting price levels while safeguarding its domestic processing ecosystem. That balance between growth and control is where the real story sits. Back in 2014, Indonesia made a decision that honestly felt reckless at the time. It banned the export of raw mineral ores, nickel included. Critics said it would scare investors. Miners complained. Revenues dipped. There was confusion, revisions, partial relaxations, then tightening again. By 2020, the message was unmistakable. If you want Indonesian nickel, you process it in Indonesia. That was the turning point. For decades, countries like Indonesia exported raw materials and watched other nations turn them into higher value products. Steel, battery chemicals, finished components, the real money was made downstream. Jakarta decided it was done playing that role. The export ban wasn't just economic policy. It was a statement. No more shipping rocks. Build the smelters here. And build they did. Morowali Industrial Park became the symbol of this shift. What used to be a relatively quiet area in central Sulawesi turned into a sprawling industrial hub, smokestacks, conveyor belts, power plants, and refineries. Then, Weda Bay followed. New smelters came online at a pace few expected. High-pressure acid leach plants, complex and capital-intensive, started operating to produce battery-grade nickel products. The numbers are big. Since the export bans, downstream investments in nickel and related metals have run into the tens of billions of US dollars. Not small upgrades, entire ecosystems. Ports, coal-fired power plants, refining complexes, chemical processing units. Integrated chains. Today, Indonesia hosts the largest cluster of nickel smelting and refining capacity in the world. Not just ferronickel for stainless steel, but increasingly nickel sulfate and mixed hydroxide precipitate, both critical inputs for EV battery cathodes. That's a completely different level of value capture compared to exporting raw laterite ore. This didn't happen by accident. It was policy-driven. Forced, even. Of course, there's another layer people sometimes gloss over, who financed and built much of this capacity. Chinese firms dominate Indonesia's nickel processing landscape. Estimates often suggest they account for well over 70% of smelter throughput capacity. That influence is visible in ownership structures, technology supply, engineering contracts, and offtake agreements. Beijing-backed capital moved fast when the opportunity opened. It absorbed risk. It built scale. That doesn't mean others are absent. Japanese and Korean firms have stakes. Western companies are present in selective projects, especially those targeting battery-grade materials with stronger environmental branding. But the concentration is clear. The core engine of Indonesia's downstream nickel boom has been Chinese industrial capital. And here's the strategic part. Indonesia isn't just exporting refined nickel. It's positioning itself inside the EV supply chain. That means chemicals, precursors, battery inputs, not just intermediate metals. The goal is vertical integration. Mine the ore, refine it, convert it into battery-grade material. Eventually, maybe assemble battery components domestically. Value stays home. Jobs stay home. Tax revenue stays home. That's the theory. It's also about leverage. When you control processing, you control supply security. Automakers and battery manufacturers can't just bypass you by sourcing raw ore elsewhere. They need your industrial ecosystem. The export ban was controversial when it started. Some called it protectionist. Some said it violated trade norms. But 10 years later, Indonesia sits at the center of the global nickel conversation. Not as a quarry, as a processor. That's the difference. And once a country builds that kind of industrial mass, it doesn't easily give it up. There's a quiet shift happening in Manila. It's not loud. No sweeping bans. No dramatic standoffs. But the conversation has changed. For years, the Philippines has been one of the world's largest nickel ore exporters. Ships leave its ports loaded with laterite ore, bound mostly for processing hubs abroad, often Indonesia, sometimes China. The country earns from volume, yes. But the higher value transformation? That happens somewhere else. And that's exactly what Manila wants to fix. The strategic objective is simple in theory: move beyond digging and shipping. Build refining capacity. Develop processing plants. Step into battery-grade intermediate production. Instead of just exporting ore, produce nickel products that feed directly into EV supply chains. Things like mixed hydroxide precipitate or nickel sulfate. It sounds obvious. Why sell raw material when you can sell something more valuable? But here's why it really matters. First, value capture. Commodity exporters live and die by global price swings. When nickel prices fall, revenues shrink immediately. There's little insulation. Downstream processing changes that equation. The margins are different. The pricing structures are different. You're not just selling tons, you're selling industrial inputs. Second, relevance in the energy transition. Electric vehicles aren't some distant trend anymore. They're policy-backed, capital-backed, supply chain-backed. If the Philippines can plug its mineral base into that ecosystem, it doesn't just sell resources, it becomes part of a strategic industry. That changes how investors look at you. It changes how governments negotiate with you. Third, foreign direct investment. Advanced materials manufacturing attracts longer-term capital than raw extraction alone. Smelters, chemical plants, precursor facilities, these are multi-billion-dollar, multi-decade projects. They create clusters. They create industrial ecosystems. That's the aspiration. But there's also a geopolitical layer here that's impossible to ignore. Indonesia's downstream boom is heavily tied to Chinese capital and processing networks. The Philippines is exploring a different alignment. Manila has been actively engaging the United States, the European Union, Japan, and South Korea, not just for trade, but for strategic supply chain cooperation. Critical minerals have become part of security conversations. They show up in alliance dialogues now. Defense partnerships and mineral supply chains are increasingly discussed in the same rooms. For Manila, building downstream capacity isn't just economic policy. It's strategic hedging. It reduces reliance on Chinese-dominated processing networks. It positions the country as a potential partner for Western and allied battery supply chains looking to diversify sourcing. In theory, that's powerful. In practice, there are constraints. Indonesia built its smelter base over a decade of aggressive policy enforcement. It has industrial parks purpose-built for nickel processing. It has integrated power supply, often coal-fired, which keeps costs lower even if it raises environmental questions. It has scale. The Philippines does not yet have that level of infrastructure. Refining capacity is limited. Processing facilities are sparse compared to Indonesia's dense industrial clusters. Energy costs in the Philippines are generally higher. Logistics can be more fragmented. Infrastructure gaps add complexity. Investors calculate these things down to decimals. Then there's regulatory clarity. Permitting timelines, environmental approvals, local government coordination, these matter enormously for capital-intensive projects. Investors want predictability. They want consistency across election cycles. They want confidence that a multi-billion-dollar facility won't get stalled by policy reversals. That doesn't mean the Philippines can't succeed. It means the runway is longer. The ambition is there. The resources are there. The geopolitical window, especially with Western governments eager to diversify supply chains, is real. But ambition alone doesn't build smelters. Manila is trying to shift from being a reliable ore supplier to becoming a serious processing hub. It's a leap. And when your biggest regional competitor already dominates downstream capacity, every policy decision becomes amplified. The Philippines isn't starting from zero, but it's not starting from Indonesia's position either. And that gap, infrastructure, cost structure, industrial depth, is the real challenge behind the headlines about downstream dreams. When Indonesia tightens output, the first impact is mechanical: less supply in the market. And in commodities, less supply usually means firmer prices. Nickel is no exception. Reduced availability creates upward pressure. That might sound like good news for producers in general. Higher prices mean higher export earnings, but downstream processing doesn't live comfortably in volatile environments. Smelters and chemical processing plants require massive upfront capital. We're talking billions of dollars, long construction timelines, and return horizons measured in decades. When nickel prices rise sharply or fluctuate unpredictably, capital requirements increase. Feedstock becomes more expensive. Project models get revised. Internal rates of return start to look less stable. In that environment, investors hesitate, especially in countries that are still building their industrial base. And this is where the competitiveness gap becomes clear. Indonesia already has an integrated mining to processing ecosystem. Ore, smelters, industrial parks, power generation, logistics corridors, it's all there. Investors entering Indonesia plug into something that exists. In the Philippines, many of those components still need to be built or scaled. That difference matters. Scale reduces risk. Infrastructure reduces friction. So when output cuts tighten supply and prices move upward, capital tends to gravitate toward the place with established processing capacity, not the place still trying to assemble it. From an investor's perspective, Indonesia offers speed. Established hubs like Morowali allow faster deployment, predictable feedstock access, and proximity to existing battery precursor production. The Philippines, meanwhile, is still designing much of its refining pipeline. Permitting timelines, energy costs, infrastructure expansion, all introduce delays. The contrast is visible in regional capacity comparisons. Indonesia's smelting throughput dwarfs Philippine refining plans, which remain largely prospective or early stage. One country is scaling an ecosystem, the other is building one. That's not a criticism, it's just structural reality. Officially, Indonesia frames the output reductions as market stabilization and environmental governance. That is the stated rationale. Oversupply distorted pricing. Illegal mining required stronger oversight. Production needed alignment with processing capacity. There is no formal declaration that these cuts are designed to disadvantage competitors. But policy outcomes do not need to be intentional to be strategic. By tightening supply while already possessing the world's most concentrated nickel processing base, Indonesia reinforces its dominance. Investors facing tighter supply conditions naturally prioritize jurisdictions with guaranteed integration. That means the structural effect of the cuts, regardless of stated intent, consolidates Indonesia's market position. This raises a more analytical question. Does motive matter if outcome produces the same geopolitical effect? Even if the policy is primarily domestic and economic in intention, it becomes geopolitically consequential because of Indonesia's scale. Dominant producers shape markets simply by acting in their own interest. For countries like the Philippines, the disadvantage may not be deliberate, but it is real. Nickel is no longer just a mining commodity. It sits at the center of EV battery supply chains. That transforms output decisions into strategic acts. Heavy Indonesian output control, combined with a processing sector where Chinese capital accounts for a dominant share, concentrates supply chain leverage in a single geography and financing network. That concentration carries risk, particularly for Western governments seeking diversification. The Philippines has positioned itself as a potential alternative. Manila's engagement with the United States, Japan, South Korea, and the European Union reflects that ambition. But structural concentration makes diversification harder than political rhetoric suggests. If most smelting capacity remains in Indonesia, and most capital remains tied to established industrial parks, supply chain maps will continue to route through those nodes. Battery precursor production, refinery siting decisions, and investment flows increasingly follow political alliances, but they also follow infrastructure gravity. In Southeast Asia, nickel policy has effectively become industrial statecraft. Resource management now intersects directly with strategic alignment. Downstream competition is no longer quiet. It is regional. And it is geopolitical. Manila is not without tools. Regulatory certainty is the first lever. Streamlined permitting, consistent environmental frameworks, and transparent mining approvals reduce perceived risk. Investors value predictability more than rhetoric. Tax incentives and investment guarantees are another pathway. Carefully structured fiscal regimes, particularly for processing facilities rather than raw extraction, could narrow competitiveness gaps. Public-private frameworks tied to allied cooperation may also reduce capital burden. There are economic strategies available as well. Instead of replicating inward in the value chain, Indonesia's production cuts aim to stabilize markets and protect long-term revenue streams. Indonesian industry statement for the Philippines, moving up the value chain is both an economic and geopolitical imperative. Philippine resource policy analysis. Tighter supply dynamics increase the opportunity cost of delayed investment. Downstream investment expert these perspectives capture the tension. Stabilization for one country becomes a structural challenge for another. Indonesia's output controls are reshaping nickel economics. Whether the intent is purely domestic or strategically calibrated, the effect is the same: greater consolidation of influence in the world's most critical nickel hub. The Philippines faces a difficult but not impossible path. Building downstream capacity requires capital, infrastructure, policy consistency, and geopolitical alignment. The opportunity exists, particularly as global powers seek diversified supply chains, but it demands execution, not aspiration. Nickel competition in Southeast Asia is no longer about who digs the most ore. It is about who controls value, processing, and strategic leverage. And that competition is now both industrial and geopolitical.
If you found this analysis valuable, share your perspective in the comments. Your insights help deepen the conversation and sharpen our understanding of evolving regional dynamics. Thank you, and we will see you soon in our next geopolitical discussion.